All right, good morning again, or good afternoon, I guess, at this point almost. As mentioned, I'm Barkley Keith, CEO and one of the co-founders of MOMNT Technologies located in Atlanta, Georgia. We were founded in July of 2019 with a team that came out of a fintech unicorn called Green Sky post-IPO. We're an enterprise-grade solution, which is truly turnkey to embed real-time lending and real-time payment products for that consumer into that enterprise experience, where that enterprise owns the experience end-to-end. We were looking at what we call the 1.0 players. They often had a situation where they did not own that consumer experience, that being the enterprise, so we wanted to give them that advantage because it's really alignment of interest. We're purpose-built, best-in-class, and we're truly turnkey. Everything from underwriting on the consumer side, the merchant side, fraud, collections, all the way through to capital markets. Our leadership team came out of Green Sky, as mentioned, but in the last 4.5 years, we've attracted a leadership team that's phenomenal from across the industry. Most of us have 10 to 15 years of fintech experience. We got a couple ex-CEOs on the board as well. So really powerful leadership team from that standpoint. Ultimately, our goal is to capture that moment of need for a major life purchase from a consumer. This is not buy now, pay later. We are not financing $500 pairs of sneakers. We are financing $15,000 to $20,000 major life purchases. We provide the infrastructure for that merchant to go out and offer their product to the consumers in a very seamless manner. And we work with lenders, be it banks, be it credit unions, or the institutional markets, to ensure the funding on the back end is secured as well. Oops. Ultimately, today we're in home improvement and elective, but this technology can be applied to a variety of different verticals to include clean tech, think solar, power sports. One of our major investors is Yamaha. Any major life purchase is something that we can really adapt our platform to, and each of these as standalone are multi-billion-dollar industries. We take an enterprise-level acquisition model, meaning we go out, we find vertical-specific SaaS, we find the manufacturers, and we weave into those platforms that our end consumer already uses. This allows us to drive down marketing costs, but also allows us to acquire that end consumer at a very low cost. We do market directly to those merchants as well, but over 70% of our partnership, or 70% of our volume comes from those partnerships, which is really powerful from that standpoint and from also a scaling standpoint. This partnership model comes in 3 different varieties. We have that referral partnership, as mentioned, that's direct. We have a branded experience where we can fully private label this to that manufacturer, to that vertical SaaS, where again, you as a consumer go in, you see the exact same workflow, it just now has financial services. And we can also embed these APIs directly where you never really see MOMNT until the very end when you accept that loan. We make sense for merchants. We make it very sticky. We allow them to, again, leverage their existing digital infrastructure to now offer these powerful financial services to further leverage their team, their experience, and their digital products to sell more product. Merchant growth, we've gone from 0 to close to 4,000 merchants in the last 4 years. Vertically, we're only in 2 of the 6 verticals we've identified, and it took us less than 2 months to move from home improvement to medical. Again, we're just formatting that platform to be very specific to the vertical. When we look at how this impacts those merchants, we're taking the exact same merchant and we're helping them amplify their base. With the exact same number and team, highlighting out a case study of a home improvement merchant that's here in Florida, they've seen their average deal size increase by close to 70%. Not only that, they've seen their payments go to overnight, i.e. no more 30 days of waiting. They're getting paid same day they start that job. This obviously improves the cash flow, but being able to use the same number of teams and get a higher deal size improves the cash flow of that business substantially. We have a diversified funding strategy where we work with banks, credit unions. We also have capital markets. We issued our inaugural ABS deal in December of last year. This is a big deal because we now have access to institutional markets. We can go out and get insurance money, which again is the lowest cost to fund money. We do not put this on our balance sheet, but we are looking at a balance sheet facility to mitigate some of the risk and some of the, call it, market disruption created by the Fed in the last year. The Fed has obviously raised rates 5 points in the last year, which is meaningful. That's why we're looking at a balance sheet strategy there as well. From a financial standpoint, in Q2, we'll fund our billionth dollar. We've gone from 0 to close to $40 million in revenue last year. In our 4th year, we did $43 million in revenue. We expect to close to double that this year. We're seeing about 5% platform fee consistently on these loans. Again, we are not putting these loans on our balance sheet. We're making 5 cents off every dollar, though. Pretty efficient. From a timeline standpoint, again, founded in 2019, we've been very specific with the dollars we've brought on. Fintech Venture Funds is a local Atlanta firm that's been very powerful. Saluda Grade was the issuer of our first ABS deal, and TrueStage is one of the largest credit union-backed VCs out there. We also took in money from Yamaha and Rockefeller, again, helping us to access those institutional markets and scale into things like power sports. Very excited about our investor base, and they continue to support us, but again, these are strategics. These are not just checks, these are folks that help us grow the business. Right now, we're in the middle of a Series B. We have a few term sheets. What I'm asking from the judges is if they would be interested in getting deeper. Obviously, we would love to have you as part of that deal as well, and I'll open it up to questions.
Did I miss how much you said? Did I miss how much you said you were going to raise? What are you looking for?
So we have term sheets for a little bit over $40 million right now. And with that term sheet comes $500 million in funding at insurance cost of funds, which will improve our margins.
And what's your preferred exit? What's your timeline for exit, and what's the method?
Yeah, absolutely. 6 to 7 years. We're 2 to 3 away from that. I would expect to go to either a major bank. There's a lot of tech companies, think your Googles, your Apples, who are really interested in financial services. And then we've got some direct competitors who have already kind of started knocking on the door. I don't expect to exit this year. I would say when the market bounces back from a valuation standpoint.
Sorry if I'm hogging. I just have 2 more quick questions. How do you compare to things like other lending platforms like SoFi? Is something I'm familiar with.
Yeah, so when you think about SoFi, again, that's going to be a mass marketed to small merchants, and really they don't have much of an enterprise grade tooling. Most of the 1.0 players, the big differentiation is we're built for enterprises from the core. And so we go into an enterprise, we're completely seamless. They build on our APIs, which makes us very sticky. They've dedicated the dollars from a development side to do that. And so our goal is not to be the consumer-facing brand, it's to be the infrastructure they run off of.
Last question from me. Just in your pro formas, what sort of multiple are you looking at for the investors that participate in this round? Any idea?
That's actually been adjusted over the last year, as you can imagine, due to the market conditions. Multiples aren't as relevant here as a few other pieces. I'd be happy to get into that offline if you'd like. Any other questions?
So at the core, if you're not, if I understood you correctly, you're not holding any of the lending on the balance sheet. So at the core, how do you get paid? Who's paying you, and how's that?
Yeah, so 2 sides to that. We have a portfolio incentive that allows us to, again, put great loans on that book and make a piece off of that, and then we have a merchant origination fee. So when you come on our platform, that merchant's going to actually pay to access that technology. That's about 9% all in, 5% coming from that merchant fee, which I mentioned earlier, 4% coming from that portfolio incentive for making good performance.
And to confirm, so the roofer comes to me, I need a new roof. Do you want to pay check or do you want to finance it? So you're going to get a piece of that action.
Absolutely. Yep.
All right.
And so we see massive market expansion too. When you look at home improvement, only 15% of projects are currently financed. We expect that to move to around 50 to 55% over the next 5 years.
And how much do you have, like a bank lender? How much business is coming from them at that point?
Well, really, the bank and lender doesn't give us business. Where we go is into the manufacturer, the vertical SaaS. So think a CRM for roofing manufacturers is someplace we're tied in directly. We have a few of the largest partnerships there as well.
Okay. Thank you.
What's the use of funds?
Use of funds is going to be to grow the team. Again, as mentioned, the market share is still very attractive. We're able to consume market and ultimately to build out that team and invest in further AI tools for the various teams within our company.
What milestones do you need to meet to hit the exit?
Oh, I mean, ultimately, this is consuming market share at this point, right? I think our technology is at a point where it's attracted to a lot of our competitors who haven't been able to build an enterprise-grade solution. And so to his question, where is the exit valuation that we feel comfortable and we feel we've created the value for our shareholders? Any other questions? All right, thank you again for your time.